Hey, good morning. This is Skylar with Regan. I'm going to quickly go over the Treasury floating rate indices as well as the T-bill indices on Bloomberg. What I have here is the U.S. Treasury floating rate bond index. You could see here it's only 8 members. The members are over here, total of about 543 billion. We could see the OAS option adjusted spread duration. It's actually slightly negative. Let's just call it 0, and a yield of about 545. You have a price of right around par, coupon of about 550. On average, these mature in about 1.1 years. Let's compare that to the Treasury bills index. These are all fixed rate, okay? Very short maturity, only about 0.3 years. But you could see here, look at the yield. It's about 524, whereas the yield on floaters is 545, okay? You're actually going out in duration here, about 0.28. See, your duration matches your maturity. Whereas on floaters, you're getting a little bit longer maturity, but because these reset regularly, you're buying into no duration and you're picking up about 20 basis points of yield here in floaters versus fixed. You can see here, this is in billions. This is 3.7 trillion roughly, about 41 individual members. A lot of these are maturing here just in the next month or so. Okay. So if we go to compare these two, let's look at the comparison or the return year to date of Treasury floaters, which is your top line in white, versus Treasury fixed, short duration Treasury fixed, which is orange. This is just year to date. Year to date, floaters have outperformed fixed by about 24 basis points so far. Okay. So then let's go 1 year. You get about 30 basis points of outperformance. 2 years, about 93 basis points. 3 years, 5 years, 10 years. You're looking at really strong outperformance on floaters versus fixed. Annualized, it's about 15 basis points. That's going to really add up over time, especially when we're thinking about folks that have upwards of $6 trillion in money market accounts. Idea being, hey, maybe you look at floating rate paper. So what are Treasury floaters? You could see here, there's only 8 individual, 9, what are there? 9 individual Treasury floaters. You have your maturities here. All of these mature within the next 2 years or so. Okay. So if we pull up this number one issuance right here, this matures in January 31st of 26. Okay. It's paying a coupon of about 557, margin over this benchmark of about 25 basis points. I just pulled up the YA screen. I think this is the YTC screen. Yield here of about 545. So that marries up pretty well. If you go back to the yield on the index, about 545, the biggest holdings, 5.45% yield, makes a ton of sense. Compare that to where bills are yielding currently, which are 535, maybe 540 on the highest individual node. This is roughly your 4-month node. But then you are kind of biased down here with your 1 year being at about 520. That's probably what drags it down. So just extrapolating this out a little bit, I like to reference LQD versus FLOT. These are two iShares ETFs. LQD is the investment grade fixed rate ETF. FLOT is the investment grade floating rate index. So extrapolating out that performance that we saw, which is, call it 15 basis points over 10 years. This is year to date fixed versus floating, about 600 basis points of outperformance year to date in floating rate investment grade paper versus fixed rate. Let's go out to 3 years. Difference here is about 21%, about 7% annualized. Let's go at 5 years. It's about 10% outperformance. Call it 2% annualized. You have to go all the way out to 10 years for fixed rate to beat out floating rate in terms of investment grade corporates. And I like this chart down here. What you're getting in fixed rate paper is you're getting a tremendous amount of volatility due to having rate duration. Okay. Whereas down here, you have a very, very steady line. This is COVID on your floating rate paper. And then you have your coupon actually picking up right here. So your coupon picking up so that your coupon on floaters is actually higher now than your coupon on fixed. So that's a good, hopefully roughly short presentation on why we think floating rate paper is really interesting versus fixed rate paper, given that it's a higher current coupon and given that you don't have to take on interest rate risk owning fixed income. Thanks.